History is a cycle of innovation and collapse, where the promise of a new era often blinds investors to the harsh reality of technical limitations. Today, we trace the recurring pattern of hype that defines our modern digital existence. In 1858, Cyrus Westfield led the Atlantic Telegraph Company to connect two continents, marking the birth of global communication. By August 16, Queen Victoria and President James Buchanan exchanged the first transatlantic message, but the cable failed just 3 weeks later. This early catastrophe caused massive financial losses, proving that enthusiasm cannot bypass the laws of physics. Scientific advisor Lord Kelvin realized that signal attenuation was the primary culprit, requiring a specialized mirror galvanometer to detect weak currents. It was not until July 27, 1866, that the massive iron ship, the Great Eastern, successfully laid a permanent, reliable cable. Connecting Valentia Island in Ireland to Heart's Content in Newfoundland, this feat finally bridged the divide between the old world and the new. This Victorian era established the boom-bust model, where infrastructure investment often outpaces the actual technical readiness of the underlying technology. Fast forward to August 9, 1995, when Netscape's IPO ignited the dot-com bubble, sending share prices from $28 to $71 overnight. Founders Jim Clark and Marc Andreessen became the faces of a movement that prioritized rapid user acquisition over sustainable revenue models. By March 10, 2000, the NASDAQ Composite Index reached a dizzying peak of 5,048.62, fueled by irrational exuberance and speculative venture capital. The crash began just 1 day later, as the Federal Reserve raised interest rates 6 times to curb inflation, drying up the liquidity that kept unprofitable startups afloat. By October 2002, the NASDAQ had lost 78% of its value, wiping out $5 trillion. This brutal correction forced a shift toward efficiency, leaving only giants like Amazon and eBay to survive the wreckage of the internet's early gold rush. We see this pattern repeating today with the launch of ChatGPT on November 30, 2022, which triggered an unprecedented surge. Current market dynamics mirror the 1990s, with massive capital expenditure on GPUs and data centers in places like Ashburn, Virginia, creating a new, uncertain frontier. The race for AI dominance is currently driving unprecedented investment levels across the global tech sector. Today, over 500 active submarine cables carry 99% of international data, a testament to the infrastructure foundations laid by the pioneers of the 19th century. These cables remain the invisible backbone of the modern, interconnected global digital economy. Regulatory scrutiny, much like the 2001 DOJ case against Microsoft, remains a constant shadow over the giants of Silicon Valley as they navigate the current AI hype cycle. History shows that market corrections are often followed by intense periods of legal oversight. The 1858 cable failed because Wildman Wh applied 2,000 volts to the line, ignoring Kelvin's warnings about insulation damage. This technical error serves as a historical reminder that rushing innovation without scientific rigor often leads to immediate, costly, and avoidable failure. Of the 457 internet companies that went public between 1995 and 2000, roughly 90% failed or were acquired for pennies on the dollar. This high mortality rate underscores the extreme volatility inherent in speculative technology markets during their early growth phases. At the peak of the dot-com bubble, the price-to-earnings ratio of the NASDAQ 100 exceeded 200, compared to a historical average of roughly 15 to 20. Such extreme valuations are classic indicators of a market disconnected from the reality of fundamental corporate earnings. The Great Eastern was so massive that it was the only vessel capable of carrying the 2,300 miles of cable required for the 1866 mission. This ship represents the sheer scale of the engineering challenges required to connect the world in the 1800s. Al Gore popularized the term information superhighway in the early 90s, framing the internet as a public utility rather than a speculative asset. This vision eventually became reality, despite the bubble that temporarily obscured the long-term potential of the World Wide Web. The current AI hype cycle is defined by the massive capital expenditure required to train large language models, creating a GPU shortage that mirrors the infrastructure bottlenecks of the past. Investors are betting heavily on monetization paths that remain largely unproven in reality. Ultimately, the history of technology teaches us that while the tools of human connection evolve, the fundamental human tendency to overvalue the future remains a constant, defining force in our global economy. Understanding this history is essential for navigating the digital age. The 1866 success proved that persistence in engineering can overcome even the most daunting physical barriers. It set the stage for the modern era of global connectivity, allowing information to travel across oceans in mere seconds rather than weeks of ship travel. Post-bubble eras historically lead to increased antitrust scrutiny, as seen in the early 2000s and potentially in the coming years of AI development. These legal battles often redefine the competitive landscape, limiting the power of dominant firms while fostering new innovation. The survival of companies like Amazon during the 2000 crash highlights the importance of long-term vision over short-term stock price inflation. Those who focus on solving genuine user needs often emerge stronger after the speculative froth has been washed away by market reality. Ultimately, the story of tech reckoning matters today because it reminds us that true progress is built on sustainable foundations, not just the hype of the moment. We must look beyond the noise to identify the technologies that will truly shape our future.